Hi, this is Kerry Artak with Wicked Stocks, bringing you an update in the TLT, that is the iShares 20-year Treasury Bond ETF, symbol TLT. This is the high volume bond ETF. It behaves like a bond. In other words, as the prices drop over time, interest rates are climbing, and inversely, as the TLT rises, interest rates are dropping. There's an inverse correlation. So you can see from March of 2020, this is the COVID low, an extreme low in the TLT. They actually, let me rephrase that, it is the highest the TLT has been in terms of its pricing in the history of this instrument, which marked a low point in interest rates, obviously, as the Fed was pumping money into or basically buying bonds in order to flush the system with liquidity. And so this obviously is the high point in the TLT over the last 5 years, as you can see. And this marks really what we see here is a longer-term trend in rising rates following the March 2020 low. And so as the TLT has progressively dropped, lower low, lower highs over the last 5 years, that has been, this has coincided obviously with higher rates. Now you can see for the last couple of years, really, you could go back to roughly the October 22 low, or you could mark the October 23 low. Either way, you could see that there's been this, there's not been the descent, the angle of descent, the continued aggressive price erosion that we saw, for instance, from November of 21 to October of 22. This actually coincided, as you may recall, with the bear market in stocks. As rates continued to rise, that was an inflationary scare. As you remember, the Fed was progressively raising rates over that period of time. And so that's just the history of it. Now, really the takeaway for me here technically is the fact that we have this very well-defined channel top. If you take this spike low from March of 20, and then you have another low here, October of 22, and you project that same angle of descent against that November 21 high, you have a 5-year channel structure that we came very close to testing back in September of 24, and we did essentially test about a month ago, the last week of March. We pushed into the 1% zone. So on any line study that's 6 months or more, I use a 1% threshold for both setting a short position or selling a particular area. I also use a 1% threshold above this black line as to when you might consider going long and buying the TLT. But really what we see here is 93.48 is a representative ceiling of the 5-year trend. This is an area that can be sold long-term, and below 93.48, dropping weekly, the TLT remains in a long-term bear market. The emphasis remains to the downside. If we were to close above 93.48 at the end of this week, then just the opposite. We have a neutralizing of a 5-year bear trend in the TLT, or in other words, a neutralizing of a 5-year bull move, if you will, or continued rates climbing over the last 5 years. So 93.48 is your ceiling. This is an update. There's also a floor of midterm support that I've shown you over the last few months at 84.64 and climbing just a few ticks a week. This is an extreme channel bottom that we did test back in January, came off of it nicely, and in the process, several months later, did test the 93.48 high and quickly fell back. This is late March into early April. We fell back to midterm support. This sell-off coincided with the stock market sell-off, coincided with the Trump administration announcing the tariffs, 25% across the board, and even much higher for China. And then that was relaxed within a week of doing so. But this was the big scare as interest rates climbed right along with the stock market dropping. There was a correlation between the bond market and the stock market that was rare. Typically, when the stock market is selling off, as it did back from early March into late March into early April, you'd see a flight to quality movement into the bonds, and you would have seen higher trade yet in the bonds. That did not occur. That was the big scare, realizing that if we kept at it, if the Trump administration did not back away from their tariff threats, that you could have seen the bond market enter a significant sell signal. And that's what I would see if we were to close below 84.64 this week in the TLT. I would see a long-term sell signal. And in fact, well, I'm not going to, it's a little early to jump to that chart. This is the chart I want to jump to. If we close below 84.64 at the end of this week, I would see another sort of 3 to 5 month sell signal that should yield sort of the equivalent of the this full channel. So I call these full channel extensions. You've got this well-defined range that we've been in. Channel 84.64 is the base of that. And if we close below 84.64, technically I would expect a full extension of that channel to 64.74. And I'd call this a 3 to 5 month target realistically. And just FYI, a 16.5% move in the TLT is generally equivalent to a 1 to 1.25% move in long-term rates. And this move from 84.64 to 66.74 is roughly 20-21%, which would be about a 1.5 to 1.75% increase in rates over the 3 to 5 month period. And that is a scenario that I would anticipate. And that is a scenario where, you've got a lot of international investors and Federal Reserve banks who are then rushing to sell their bonds that they're holding. And I don't want to get, into all that. I'm sure you've read enough about all that. And so really, this is just a technical snapshot of the TLT, that if we were to close below 84.64 at the end of this week, I see no compelling reason to be long the TLT. In fact, you want to be short the TLT. If you can sell, say, buy 67 strike out of the money puts, that would be a decent options play under that scenario. And I would give this inside of 6 months to fully play out. And that is the downside scenario. Until then, I see us locked in this wedge between midterm support at 84.64 and long-term resistance at 93.48. Of the two levels, 93.48 is by far the more significant, by far the stronger of the two. In other words, the chances are still that we will close below 84.64 before we will close above 93.48. And I'm not going into the macroeconomics of this. I'm just talking about the pure technicalities. The fact that you have a 5-year descending channel top that is competing, if you will, for price direction with a more midterm inside of 2-year channel bottom. So closing below 84.64 is a short play for the TLT. As we continue into the third quarter, I would expect the mid-60s or the 66.74 full channel extension. Consistent with that is a long-term trend line off the lows back in October of 22 and October of 23, of 1 year trend line here that continues through time. It is at 68.09 and will by early June be converging with the full channel extension anyway. So that is the reality of it if we were to close below 84.64. I see no reason to expect 66.74 to 68.09 unless we do close below 84.64, because there is also the possibility that in the coming weeks we close above 93.48, and I'll get to that in a moment. But let me jump to this chart real quick. This is mostly for you swing traders who like to trade the 3 to 5 week time frame. You could be bottom picking 84.64 in anticipation of 93.48. We could continue to fill this wedge out for the next few months. If we close below 84.64, I would expect 80.85 within 1 to 3 weeks, and then we could trade both sides inside of this wedge between 80.85 and 84.64 for a number of weeks before presumably the market then also closing below 80.85. It is a settlement below 84.64 that would have me expect 66.74 within 3 to 5 months. I'm only showing 80.85 as a level that's tradable for those of you who actually trade the TLT, and you might actually trade the 3 to 5 week time frame or the 2 to 3 week time frame. Now, moving back to this chart, actually I want to go back to this one here, and that is this wedge between 84.64 and 93.48. If we were to close above 93.48 in the coming weeks, that is a meaningful shift in the long bond rate. Or in other words, I would expect upward continuation to 102.95. And this would be obviously coinciding presumably with lowering rates. This scenario, is this a flight to quality? Or is this, I think the market has already shown that as the stock market drops We've also have the long bonds are also dropping. This is a new phenomenon. And so what is the scenario? We could scratch our heads over this, whereby we close above 93.48. I think it's kind of a flat stock market and an economy that is weakening. And that there is a flight to quality. In other words, closing above 93.48 within 2 to 3 months, I would expect 102.95. And it is this kind of 1 to 2 year channel top that may well contain quarterly buying pressures, and we could fall away from here. But closing above 102.95, and this is the last thing I'll say, would be, I think, an indication of continued lowering rates on a progressive basis. And I think that would probably coincide with an outright recession. Maybe even a global recession, where you've got the TLT just continuing to climb out of this area with a settlement above 102.95. That would be the technical expectation. With a settlement above 93.48, that neutralizes the long-term bear trend in the TLT. That neutralizes the longer-term rate rises that we've seen over the last 5 years. The question is whether we'll continue to see rate reduction as the Fed then once again attempts to save the economy, if you will, by lowering rates and buying long bonds. Closing above 102.95 is my personal alarm for recession or an impending recession. But I don't want to get too carried away, too dramatic with all that. I will leave you with this image. Inside of this area, we have a very well-defined two-sided framework in the TLT. You can trade both extremes, and closing outside of this range, 84.64, 93.48, is an indication of a directional likelihood in the respective direction on a multi-month basis. I think that pretty much rounds it out. I'm going to leave it at that for this particular Wicked Stocks update on the TLT. Have a great day.